You have an edge, a real one. Your strategy works. You've tested it. You know it works. But your results don't match your strategy. You're leaving money on the table. Your win rate is lower than it should be, and your losses are bigger than they should be. And you're wondering why the edge isn't working the way it did in backtests. So here's the problem. You're not trading the same size twice. Monday, you trade one size. Wednesday, you trade bigger because you're confident. Friday, you trade smaller because you're scared. And by the time you're looking at your monthly results, the variance in your sizing has destroyed your regulation score and buried your edge. And I'm going to show you what that costs and why consistency in sizing, not just consistency in following your plan, is the edge that separates profitable traders from broke ones. Most traders think about consistency in one way. Did I follow my rules? Did I take the setups? Did I exit at my target? And those things matter. Execution integrity matters. But there's another dimension of consistency that most traders ignore. Did I trade the same size? Because sizing isn't just a money management question. Sizing is a regulation question. And variance in sizing creates variance in your nervous system's response to the market. When you trade size A on Monday, your activation level responds in a specific way. When you trade size B, bigger, on Wednesday, your activation level responds differently. When you trade size C, smaller, on Friday, it responds differently again. Now you've taken the same setup 3 times, but you've taken it from 3 different nervous system states, 3 different activation levels, 3 different regulation scores. And your results reflect that. Not because the strategy is different, because your regulation is different. Here's how this compounds. You trade size A on Monday. The trade works. You feel good, confident. Wednesday comes. You're riding that confidence, so you trade bigger. Size B. You're thinking, if this setup is reliable, I should size up and capture more of the move. But your nervous system knows you just went bigger. And even though you're confident, your AL, activation level, is elevated. You're not as sharp. You exit earlier. You leave money on the table. The trade would have worked at size A, but at size B, from an elevated AL, you miss the full move. And then Friday comes. You're tired. The week has been grinding. You had that near miss on Wednesday, so you trade smaller, size C. You're protecting yourself. But now your AL is lowered because the size doesn't demand your attention. You're sloppy. You hold a loser longer because it doesn't matter as much. The trade would have lost at size A, but at size C, from a disengaged state, you lose more than you should have. Now, your 3 trades looked like this: win, near miss, extra loss. Your edge should have produced win, win adjacent, small loss. But the sizing variance changed all 3 outcomes. This is where it gets really clear, your regulation score. The composite metric of how well you're trading across all dimensions is directly impacted by sizing inconsistency. If you trade the same size across all your trades, your RS is stable. You can see real patterns. You can see if your edge is working or not. If you trade 3 different sizes, your RS bounces all over. One trade you're at 82 RS, next trade you're at 71, next trade you're at 67. And you're looking at your monthly data thinking, my regulation is all over the place. Because it is. Not because your regulation is bad, because your sizing is all over the place. And sizing drives regulation. So here's the thing that most traders don't realize. If you trade the same size consistently, your RS stabilizes. Your EI percentage becomes reliable and your win rate becomes predictable. And when those things are predictable, you can finally see if your strategy actually works or not, because the noise is gone. The variance from inconsistent sizing is eliminated. I've tracked this with many traders, and here's what the data shows. Traders who trade the same size or a very narrow range, like 80% to 120% of their baseline, have one, regulation score that's 3 to 5 points higher on average, two, execution integrity that's 12 to 18% higher, and three, win rates that are more consistent week to week. Four, less catastrophic losing days. Why? Because the size and consistency means the AL response is predictable. And traders who trade 3 or more different sizes, big shifts from week to week, have one, a regulation score that's all over the map, two, execution integrity that varies wildly, and three, win rates that bounce up and down unpredictably. Four, more catastrophic days where everything falls apart at once. Why the difference? Because inconsistent sizing creates inconsistent regulation. And inconsistent regulation means the strategy is competing against a nervous system that's in different states every trade. So here's what you do. First, identify your current sizing range. Look back at your last 20 trades. What's the smallest size you traded? What's the biggest? Calculate the ratio. If you went from 1 micro contract to 5 micro contracts, that's a 500% variance. That's too much. If you went from 1 to 1.2, that's a 20% variance. That's reasonable. Most traders are somewhere in the middle, maybe 50 to 300% variance, which is too much. Second, establish your baseline size. This is the size that you trade when conditions are neutral. When you're well rested, the market is normal and you're not carrying emotional weight. This is the size you calculated in video 8, your psychological optimal. Third, build a rule that ties size changes to regulation metrics, not to discretion. For example, you only trade at 120% of baseline if you've had 3 consecutive winning days and your RS is above 80 and your EI percentage is above 85%. You only stay at baseline if your metrics are normal. You decrease to 80% of baseline if your EI percentage drops below 70% or your RS drops below 75%. When you tie sizing to actual metrics, you eliminate the discretionary variance. You remove the emotional sizing decisions. And fourth, track your RS before and after this change. Measure 1 month of sizing variance, then 1 month of sizing consistency. The difference will shock you. Here's what matters. Your edge is real, but your edge has a precondition. The precondition is that you trade it from a regulated state. When you trade 3 different sizes, you're not giving your edge a fair chance. You're taking it from 3 different nervous system states and wondering why the results don't match your strategy. Sizing consistency is not limiting. Sizing consistency is clarifying. It's the difference between having an edge and proving you have an edge. And most traders would be more profitable trading the same size consistently than they would be trying to size up and scale, because consistency eliminates the variance that's hiding the edge. So for the next 2 weeks, I want you to do this. Identify your sizing variance ratio, then commit to trading at 1 size only. Same size every trade, no exceptions. And after 2 weeks of data, you'll see your regulation score, your execution integrity percentage, and your win rate. And you'll know if the consistency was the missing piece. I'm also offering a complimentary 1-hour trader performance audit with me over Zoom. And in this session, we'll look at your sizing patterns and build a scaling rule that keeps you consistent while still allowing for growth. So apply using the link in the description. And drop a comment. What's your sizing variance ratio? Are you trading 3 different sizes like most traders? Subscribe, share this with one trader who sizes up and down constantly, and we'll see you next time.